Do you worry about the downside risk in stock investing or market corrections and crashes keeping you up at night? But here's the big question. Are there more negative return years or more positive return years? To clear the air, we have financial expert Mr. Satish Prabhu with us today. Satish Prabhu, can you enlighten us on this?
Equity investments in India are far lower than equity investments that are done by retail investors in other countries across the globe. And why is that? We always fear that the markets will fall. And typically, we are worried about these situations that you see on your screen. But if you look at in the last 25 years also, there are just these 5 years out of 25 years when the markets are negative. And the reason why we are scared is because of just these 5 years. 20 of these 25 years, the markets have shown a positive return. And overall, it has given a 12% compounded return. That is the market. The mutual funds have given better returns. But only for these 5 years are we scared that no, we should not put our money into equity mutual funds. And we can see here that, the green bar are the investments that people make. So the year of COVID, while all the green bars are positive, the year of COVID, which was, FY21, there is hardly any investment that is made. Why? Because the markets fell by 40%. You can see here, there is a dip in March 2020 and the markets fell by 40%. And people felt that, the markets are not going to rise again. But the moment the market started rising, again, people started putting money in the market. So we have this psychology of greed and fear. We invest when markets go up and we remove all our money when markets go down, or we don't invest when markets go down. Today, the same thing is happening. Maybe it's the best time to put extra money in the market because the markets are available at a discount today. You are getting what was available 6 months back. And if it was 6 months back, we were all eager to invest more money. Look at our situation somewhere in June or July. We were saying that I want to invest more money, but the market is only going up. I'm waiting for the market to correct. Now the market has corrected and it has come back to June, July levels. Now we are saying that, oh, the markets may fall further. I don't know what is the bottom and I don't want to put in more money. So that is our situation. We behave differently at different points of time for the same level of the index. So this is how people behave. They don't invest when markets fall, but they invest more when markets rise. But I feel that it should be more uniform. People should invest across market cycle.
Thanks for a detailed answer. If you have any doubts regarding this or any other financial decision, don't hesitate to book the free appointment with our financial experts. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our free live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like. If you are new to our channel, please do subscribe. Thank you for watching.